The tankers are full, but China isn't taking them. In June, United States energy exports to China collapsed to zero. Not one barrel of crude, not one shipment of gas, not a single ton of coal. Bloomberg calls it a sudden blackout in trade flows worth billions a month. For American producers, this is more than a slowdown. It's the nightmare scenario. The world's largest energy buyer shutting the door overnight. And the real shock, China isn't scrambling. It's already replacing the United States with Russia, Iran, and its own pipelines. Reuters reported in May 2025 that even after Washington and Beijing announced a temporary truce on certain tariffs, Chinese buyers made no move to resume energy purchases from the United States. The reason was not just price, but risk. Chinese refiners and utilities told the Financial Times they had no confidence American supply would remain stable if political tensions spiked again. Reliability, not cost, became the decisive metric. The collapse began with liquefied natural gas. In the first quarter of 2025, Chinese imports of United States LNG fell by more than 70% year-on-year. According to customs figures summarized by Bloomberg, by March, no shipments were arriving. Analysts at Caper, a commodity data provider quoted in Reuters, noted that this was the longest halt to United States LNG deliveries to China since the trade war in 2019. The trigger was a tariff increase. Beijing raised its duty on United States LNG cargoes from 15% to 49% in February, making American gas commercially unviable overnight. The shutdown is striking because Chinese companies hold long-term contracts with American LNG exporters. Sinopec and Petrochina signed multiple agreements with United States producers in 2021 and 2022 to secure supplies through the 2040s. Yet those volumes are not moving. The Financial Times reported in April 2025 that force majeure clauses and delayed cargo nominations have left terminals on the United States Gulf Coast with idle capacity. Billions invested in export infrastructure now face uncertain payback. Crude oil tells a similar story. In June 2024, China imported 166,000 barrels per day of United States crude. By March 2025, the number had fallen to zero. Reuters pointed to two factors: tariffs in China at the 10 to 15% level and discounted Russian barrels flooding the market, with Moscow offering cuts of $10 a barrel compared to Brent. Chinese refiners had both political cover and financial incentive to redirect away from American supply. Coal, too, has vanished from the trade ledger. In June 2024, Chinese buyers purchased $90 million worth of United States coal. By mid-2025, monthly sales were down to negligible single shipments. A Reuters breakdown of Asia's commodity flows showed that in May, only one United States coal cargo discharged in a Chinese port. The structural change is unmistakable. The largest coal consumer in the world no longer looks to the United States for supply. Ethane, a key prochemical feedstock, was until recently a bright spot. U.S. exports to China exceeded 500,000 barrels per day in 2024, feeding coastal cracker plants that turn a thing into plastics. But the U.S. Commerce Department introduced a licensing requirement in May 2025, forcing exporters to apply for permits before shipping a thing abroad. Reuters reported that the new rule instantly stalled tankers. Contracts covering 284,000 barrels a day slated for June never left port. Industry executives told the Wall Street Journal they feared the licensing process would politicize every deal, making China's position as a buyer even more tenuous. This leaves Chinese industry in a delicate position. Without U.S. ethane, coastal crackers face higher costs sourcing from the Middle East. Bloomberg cited executives warning of losses of up to $700 per ton if forced to rely on alternative suppliers. Yet, Beijing appears willing to absorb those costs for the sake of supply security. The calculation is that short-term disruption is preferable to long-term vulnerability. At the same time, China has deepened its reliance on pipeline gas from Russia and Central Asia. Bloomberg noted in late 2024 that pipeline gas accounted for 41% of China's total natural gas imports, a figure rising as LNG purchases flatten. Domestic production is climbing as well. National Bureau of Statistics figures show Chinese gas output rose 5.6% in 2023 to 232 billion cubic meters. Taken together, these sources reduce Beijing's need for seaborne U.S. LNG. The knock-on effects are global. Reuters reported in August 2025 that U.S. crude exports dropped to 3.1 million barrels per day, the lowest since 2021, as both Asian and European buyers cut orders. Shipments to Asia alone fell to 862,000 barrels per day, the weakest since 2019. With China absent for a fifth straight month, the Gulf Coast faces bottlenecks. American barrels are being rerouted, but at discounts that compress margins. The International Monetary Fund warned in its July 2025 commodity outlook that structural demand shifts away from U.S. energy pose long-term risks to American producers. Investments in LG terminals, pipelines, and export facilities assumed steady Chinese demand through 2040. If Beijing's pivot to Russian pipelines and domestic production persists, those assets risk becoming stranded. For Beijing, the strategy aligns with a broader environmental trajectory. A study cited by Reuters in August 2025 found that China's carbon emissions fell 1% in the first half of the year, led by a 3% reduction in power sector intensity. Expanded renewable generation and efficiency measures cut coal burn at the margin. Less imported fossil fuel not only reduces exposure to U.S. leverage, but dovetails with climate targets. Yet the transition is uneven. The Wall Street Journal highlighted in June 2025 that China's petrochemical sector remains heavily reliant on imported feedstocks. Ethane, naphtha, and LPG are essential inputs for plastics and industrial materials. If U.S. supplies are politically off-limits, China must balance between Middle Eastern producers and domestic substitutes. That reliance could prove a choke point if geopolitical frictions widen. Meanwhile, U.S. clean energy developers face their own paradox. The Financial Times reported in July 2025 that tariffs on Chinese solar panels and wind components have raised costs for American projects. As a result, U.S. decarbonization efforts now face delays just as fossil fuel exports to China collapse. The decoupling thus cuts both ways. U.S. energy exporters lose markets, while U.S. clean energy developers face higher input costs. These shifts reverberate through agriculture as well. The U.S. Department of Agriculture noted in May 2025 that soybean and corn exports to China were already declining due to retaliatory tariffs. Now energy joins agriculture as a sector decoupled from its largest overseas customer. The assumption that Chinese demand was permanent has been disproven twice in less than a decade. The political consequences in Washington are immediate. Lawmakers from energy exporting states warn of job losses and fiscal strain. Reuters quoted Texas officials in July 2025, arguing that LG terminal projects representing billions in investment may never reach full capacity. Policymakers are left grappling with the reality that global energy demand is shifting in ways that undercut the core rationale for those projects. Yet markets remain strangely calm. Goldman Sachs analysts told Bloomberg in February 2025 that the impact of Chinese tariffs on global energy prices would be limited. Oil benchmarks have barely moved. LG prices have stayed within expected ranges. If prices are stable, does that mean U.S. losses are being offset elsewhere? Or does it mean markets are underestimating the long-term structural change underway? India provides one partial answer. Reuters noted in June 2025 that Indian imports of U.S. crude rose from 175,000 to 253,000 barrels per day in just 3 months, while coal imports increased 12%. That suggests some volumes are being absorbed by other buyers, but scale matters. India's capacity cannot match China's. Diversification blunts the blow, but it does not erase it. Europe is also constrained with its own climate goals. The EU is reluctant to lock in long-term fossil fuel contracts. Imports of U.S. LNG remain significant, but are capped by both infrastructure limits and policy commitments. The gap left by China cannot easily be closed by Europe. The longer this persists, the more permanent it appears. The Financial Times observed in April 2025 that Chinese energy firms have shifted procurement departments to Moscow and Thrawn. Institutional knowledge is being rewritten when contracts, shipping routes, and trading desks reorient. Returning to old patterns is not simple. The zero numbers are stark. 0 US LNG into China in March, 0 crude in June, 0 coal by mid-year. Each is a data point, but taken together, they describe a structural decoupling. Once supply chains are broken, trust is harder to rebuild than pipes or tankers. The underlying question now looms larger than the trade balance. If China no longer depends on American energy, what leverage does Washington retain in negotiations? And if U.S. infrastructure was built on the premise of permanent Chinese demand, how much of that investment becomes sunk cost? A tanker idling at sea may look like a temporary pause, but if it never unloads, if the contracts that once guaranteed delivery are no longer honored, the pause becomes a symbol. It represents not just a collapse in trade, but a reordering of global energy flows. And so, the final question remains. Was June 2025 the month when U.S. energy exports stopped? Or was it the moment the world learned that China could simply choose never to restart them? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your